You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey everybody, thanks for joining another episode on the Reinvest Podcast. We dropped a little Easter egg last episode for those of you that didn't know that the RE in Reinvest stands for real estate.
Which I feel like some people had to have gotten that.
Dude, I'm telling you, we've had so many people.
We've had
that
people
did not
mispronounce.
put that
Well, it's a dual purpose. Reinvest because you're reinvesting funds into real estate, but also real estate investing, REI. Yeah. I don't know. It could mean anything.
One could say it's a duality.
One could say it's everything. All we know is that it's not the RE Invest podcast. We've had people say that before. We're like, yeah, that's not our podcast. So
yikes! No, it's a fair thing to make a mistake on. But so that you know, and there's no confusion, Reinvest Podcast. We're excited today. We have never covered this subject matter on the podcast in the last almost 3 years that we've been doing this, which is a little surprising.
Well, and anybody that's investing has heard of this product and this strategy. But if you're in a smaller market, you probably really just don't have lenders that do this locally.
Right.
So like the big cities probably all got this in just an abundance, but in smaller markets, you probably just don't even know who to reach out to about this.
Well, they do today because on our show is Jacob Singer with Pimlico Capital. How are you, Jacob?
I'm doing great. Thank you so much. Thanks for having me.
So you're in Baltimore, Maryland. Are you native to Baltimore, Maryland?
I am not. I'm actually originally from Los Angeles, California.
Whoa. All the way across the country.
Yeah. That's across the pond, as they like to say.
Wow.
About England.
Yeah.
When did you move to
my
Maryland?
family moved out here about 20 years ago. So born, I wouldn't say raised, but raised in Baltimore.
Okay.
So you spent most of your time on the East Coast, but you were born on the West Coast.
Yeah, that's my claim to fame.
Yeah, that's your claim to fame. Was there a reason your parents moved all the way across the country? Was it family, job opportunity, or?
Yeah, job opportunity. My dad definitely got a good, opportunity here in Maryland, so moved out here.
So, question for you: do you still have family in Los Angeles?
I do. Yes.
I'm sure it's been pretty fresh then for you guys with all that's been going on over there.
Yeah, it's definitely an eye-opening experience. Definitely hearts out to everyone out there. I have a lot of family there and my in-laws as well. My wife's from Los Angeles. So definitely a lot going on and, praying and thinking about them every single day. So,
man, that's wild. Well, thank you for taking time to come on today and unpack something that I think a lot of people have heard of. If they've been on Bigger Pockets, I mean, there's a lot of different forums. It's kind of come into the mainstream, but DSCR loans, that's what we're going to talk about today. Give us a little bit of context, though. Pimlico Capital. Tell us maybe about the founders, how the company got started, because it's not your traditional, it's not like a lending institution when it comes to like just banks and holding deposits. You guys really specialize more in the mortgage side of things. Is that right?
So yeah, it's definitely one of our specialties. We do have two different products, and one of them is the DSCR product. The other side is our short-term loans, which is well known as fixing and flipping houses in different areas. But we do very much so compete and specialize on the DSCR mortgage side.
Tell us a little bit about how the founders got their start for the company.
Yeah, sure. So probably about 7-8 years ago, Pimlico was founded by our founders. They were flippers in Maryland, in Baltimore City. So they went through the whole system just like every ordinary investor, looking for loans, looking for financing. And they found it, to be very, very difficult. So they went ahead and started their own private lending company. And their motto was, we are going to make the system and, the plan to get a loan as simple and as easy as possible.
So it was the product that they wanted when they were investing.
Exactly. Because it could be such hard work just to get financing, whether going to a bank or just not knowing who you're talking to. So they created this company to build relationships and, become a partner with these investors to make it, as simple as possible to get a loan.
Which is really smart because if you're an investor and you're trying to transition into full-time investors, banks essentially don't like you anymore. So as
Yeah.
soon as you shut off the flow of the W-2 income and you're 1099 or you're living off your rental income, I mean,
Yeah.
it just becomes, you become just so much less desirable from a banking perspective now that you're self-employed. So
Less desirable in other areas too, even. You know what I mean?
I don't know what you mean, but but so it definitely makes sense that these guys were investor minded to come up with some of these products.
So
Yeah.
Jacob, give us a little like where did DSCR loans come from? Because most people, before you answer that question, most people were used to buying something in your personal name, doing a non-owner occupant 30-year fixed rate loan. You do 10 of those, and now you have to pivot into the commercial loans, right? So now you've got an ARM and you've got something on a 20-year amortization schedule. Then the DSCR loans come out, and tell us like how.
And explain, what does DSCR mean?
What does that even
Yeah.
mean?
Sure, sure. So DSCR stands for Debt Service Coverage Ratio. And to make it as simple as possible, if you're making money, if your property is cash flow positive, you got yourself a good DSCR. If you're bringing in rent and that rent can cover your mortgage payments, you're good. Everything's working out, and basically your property is eligible for a DSCR loan.
So tell us why did this pop up all of a sudden as an option for people to get financing in? Because it's not just Pimlico, right? There's other companies out there that do these, and it's become quite the buzz.
Yeah, for sure. It's definitely very competitive market. So, probably 17 years ago when the financial crisis hit, um, these private companies, these private lenders, as well as hedge funds, decided like we want to get in on this. It's so difficult to get with the bank, and with everything that happened, they basically told these investors, we want to invest in your property. Give us the opportunity. So that's basically how the DSCR loan was created, and it gives these other investors slash lenders the ability to get in the property with you and invest as well.
So normally, just to kind of show the contrast, right? We talked about what the normal strategy is. If you're not using a DSCR loan, you try and get just execute on the fundamentals of real estate. And one of those fundamentals is to fix your interest rate as long as you can get it fixed. And having that predictability of what your mortgage payment's going to be, what your input costs are. But you can only do so many of those in your own personal name.
Yeah.
And the DSCR loan is a 30-year product. It's fixed rate. It's a little bit of a higher interest rate than what you're going to get maybe on traditional lending, but it does fix that rate in and give you that predictability. So tell us, like, what does a bank normally want to see in the way of a debt service coverage ratio? And then what are those stipulations for qualifying for a DSCR loan?
Yeah, sure. So great question. So I'll get into the bank. The bank is a long process, and what everybody hates to hear is they want your tax returns. They're gonna ask you for this and this and this, and it's just, too big of a headache. I've heard of it so many times from the people calling me left and right, and they come crying like, I need to get my equity out of the property, help me out. And I asked them like, hey, did you go to a bank? And they're like, yeah. I'm like, okay, call me. You got to call me first. I'll do the exact same thing, but it'll take me one third of the time. Um, there, with the DSCR, all we need is a cash flowing property and a good credit score. And I can lay out everything that you want to see within 10 minutes. I'll get you a quote. It'll show your principal, your interest, your taxes, your insurance, everything bundled together, the rent that you bring in or that you will bring in after fixing up a property. And you can make that decision of whether this is a good loan for you to pull all your money out. And we're not so off when it comes to the rate. We go based off the 5-year treasury. Right now it's at like 4.5%, I believe. It might actually be a little lower. And every lender's, gonna be I would say about, 2.5 points above that. And your bank is not going to be anywhere, far from that. It's going to be close to that as well. So right now, good credit score, everything's, property is cash flowing. You'll get an interest rate of around 7% these days.
Wow. And so, but there's also a stipulation with this loan product. Well, I don't know about you guys. A lot of lenders that we've talked to that do DSCR loans, there's a minimum loan amount of like either $75,000 or $100,000. Is that true? What is it for you guys, and why is that the case? Because I can go to a bank, and most banks don't have a minimum loan amount, like
Right.
local or regional banks.
Yeah. So we definitely, most lenders have that minimum. We're not a bank, so we don't have, all the luxury of taking any loan that we can get. So our minimum is, I would say, depends on the program, depends on the square footage of the property, depends on the rent and who's actually asking for the loan. Um, Across the board, I would say it's between 55 to about $75,000 loan amount.
Oh,
Um,
really?
yeah, and then at the same time, you have to factor in, the minimum value of the property. So sometimes, in a scenario, the minimum value has to be 100,000, or if you're bringing in 10 properties under one loan, which we can get into later, portfolios, a minimum value of a property could be around $50,000. So it really depends on the situation, but really every scenario we should be able to have an eligible loan for you unless there's something, that we're missing, like credit score, or you actually don't have the rent coming in that'll cover your mortgage payment, and DSCR.
So here's just another question. I don't know. This is probably going to take us further down the rabbit hole. So what if it's a property that's not, because you come across this a lot. There's a property, an investment property for sale, and maybe it's vacant now, but it's move-in ready, or, with some light touches, it could be move-in ready. Will you do a DSCR loan if the property is vacant off of projected rents?
Yes, we will. So the different
Is there
scenarios-
nothing they can't do?
I'm happy you asked that because it's a really great point. Because a lot of people get scared, like, I don't have a tenant, like I don't have someone to cover my payment. But the benefit is where I don't have any caps. If you bring me a recently rehabbed property and you're looking to hold it, we have that comfortability knowing that you're going to get a tenant in there. And your interest rate is not going to be like that hard money loan you got to fix up the property. It's going to be way less. And now your only goal is to get a tenant in there. But at the same time, you just cashed out on a 75% LTV. Your leverage is all the way up there. You pull out all that money, and now you have the money to, if you can't get a tenant in there, you have that, ability to pay. And if you do get a tenant in, 2-3 weeks after getting the DSCR loan, take that money and go run and grab another property and do the exact same thing.
All right, let me put some pieces together for somebody listening to this. All right. Scenario A, you have a W-2, you work a normal job, you take your disposable income and you dump it into real estate investments, right? Buy a property, save up money, do it again. And at some point, you're going to hit, your debt to income ratio, where the bank's going to be like, hey, you've kind of maxed that out. You've eclipsed what we feel comfortable with. Maybe you've acquired those properties so quickly that the bank's not going to look at the assets that you have because they haven't seasoned. So now you're faced with, using hard money, stopping and waiting until you make more money, or they'll recognize what you own. Or you go get a DSCR loan for a property that cash flows, and you keep on executing the strategy. So that's number one. Number two, the power of this, the whole title of this is Power of DSCR Loans. The power of this is that you're able to cycle your capital faster. And that's in this, arena, that's the name of the game, is being able to put that money to work again, because every time you deploy capital into a property, you get all of those levers that you're pulling. Tax depreciation, you get the appreciation of the property, the cash flow. So you want to put your money back out there as soon as possible without having to wait and get sidelined for a long time. The other thing is, if you've gone and moved from W-2 to 1099, a lot of banks want to see you have 2 years worth of tax returns before they're going to lend you traditional financing. And I experienced that when I went to real estate. It took me 2.5 years because of when it fell into the calendar year before I could get a traditional loan. So I had to get really creative. Had I had a DSCR loan product at the time that I felt comfortable with or knew about, it would have been a great scenario. So if you're listening to this fits in your tool belt. It's just a matter of figuring out kind of like where does it fit. Let's get into what you talked about, Jacob, with packaging properties together, right? Everybody's familiar with kind of bundling together multiple properties, maybe saving on some closing costs or just making it easier to go through the process once, knowing you have 5 properties.
But usually, once you do that, you're kind of in the commercial realm again, and you have commercial terms, and you're on a 20-year amortization. So what's that look like from a DSCR perspective?
Yeah, sure. So I kind of view it as the same as if we would deal with one property. It's basically you take all the values, you take the DSCR, you're averaging everything out. If your DSCR happens to be when it comes to a portfolio, it's a little bit higher than 1. It's around like 1.15. We need it to be above. And that would, give us the comfortability knowing that all the properties will be cash flowing and everything will work out well and it'll DSCR well. But it's actually very simple. Everything we ask for on one property, we're going to ask for the 10 properties that you add to your portfolio. And there's many ways that we can like pick and choose which properties to throw into each bundle. Because sometimes you got properties with debt and sometimes you got properties that are free and clear. And if you have the max cash out and the max LTV, you are going to have a little, rate adjustment because of that. And that might benefit you because you can take all the properties that will have the max cash out, put it over here, and then you take the other 5 properties, let's say, that 3 out of the 5 of them have debt on them, and then the other 2 are your most valuable, and you'll cover the loan, will cover the payoff for those properties. And because it's not a max cash out, you're not going to get a higher rate and you're going to pay off your debt. And now you're in a good interest rate. You got cash coming in from here a little bit to pay off the debt. And then on the other side with the properties we did in the other loan, you got your max cash out. You can walk away happy and move on and build your portfolio.
Yeah, that's having that flexibility is fun to get to. Being new on the real estate investing side, you come into the market as a buyer because you don't own anything yet.
Yeah.
But once you've owned some property for a few years, you start owning stuff for 3 to 5 years, especially in the last 3 to 5 years that we've seen. You've probably got some equity in those properties. And so then it's really fun to go into a scenario with a lender like yourself and figure out how you can extract that equity out in a way that's still going to let you cash flow. And then you have this nest egg that you can redeploy into another, project.
Right.
So that's a really cool spot to be in. Awesome. What have we not covered when it comes to DSCR loans that you think would be applicable for someone listening to this today?
I would say, I think we mentioned it very briefly when we were talking about the banks, but what a lot of people don't know is how quickly a property, a loan can close with the DSCR model. Okay. A lot of people call in and they're like, yeah, we know you're not a bank, but I need my money. Can you get this, loan closed for me? And the answer is yes. You give me about 3 to 4 weeks, good communication, the title company is communicative and, the appraisal is out and ordered. We can close, in 30 days or less. You go to a bank, it could take anywhere from, I don't want to say 60, but, I'd say like 90 days, for a normal loan to close with a bank. So DSCR is definitely a way to go if you're someone who's a seasoned investor, takes a lot of opportunities that come, their way. And you can jump on them because you have the funds to do that.
Yeah, that speed is huge. Especially when you're talking about, think about trying to close a loan in rapidly changing rate environments. That open time when something's under contract and not closed, you just always feel the exposure of something changing with the seller, with the bank, just the industry as a whole.
All right, last question before we move on. If someone came to you and said, hey, I want to do a DSCR loan, what information do they need to provide?
Great question. So it's not a lot. To get a quote and to get a term sheet out to you for you to sign that day and get the process started, I need an address. I need the purchase price that you purchased it for, or oh, actually, a good point we can get into after this is the different types of DSCR loans, either purchase or refinance types of loans. But I need purchase price. You need your payoff, estimated value of the property, taxes, insurance, and if you have rent, what is that monthly rent or what you think the projected rent, market rent will be, and just an estimated credit score. And that's it.
Mm.
That's all I need from you.
I mean,
Nice.
that can all get rattled off into an email. I mean,
That's
that's
it.
that's
I can
pretty.
send me an email. Hey, be like, hey, Jacob, I got a property. I need to refinance. I'll send you back a response with a template. Takes you about 30 seconds to fill out. I'll put it together and I'll send you a quote, for your, what you need and what you want.
Before you talk about the two different loan products of rehab and purchase versus just refinance, what are closing costs like compared to a bank or just in another scenario?
Yeah, great question. So I wouldn't say we're so competitive when it comes to closing costs with a bank. I don't believe banks are going to, charge you, um, you know, higher origination points or, whatever else anyone else is going to charge you. With Pimlico, we kind of leave out the garbage fees that a lot of, other people have different ways of making their money, other lenders. But for us, it's pretty straightforward. We'll charge you standard 2 points of origination. And then we have around a $1,500 legal fee that we pay our legal team, to review the documents and get everything in order for us. And then we have around 595 processing fee, that we use for our processing team to be able to process your loan, work with title and insurance. And that's it. That's everything you're going to see from us on the HUD is a legal fee, processing fee, and origination. And then a lot of people ask, like, hey, what about the appraisal? So when it comes to the appraisal, a lot of lenders are gonna, take a step back and be like, this is on you. We don't have an appraisal company that we like say, oh, go to them, do this or whatever. We use something called an AMC, which is an appraisal management company. Most lenders have this requirement where the appraiser who's going to, appraise your property have to be associated with an AMC. So it's a third party in that, how we how they pay for it is we send them a link to this third party. They set them up with an appraiser. They're going to pay them out of their pocket. So you're not going to see it on the HUD. You're not going to see it anywhere. We'll put it in our term sheet just for you to know. But that's a separate payment and a separate thing that goes on. But that's not a part of closing costs.
For refinances, do you guys ever do like a desktop appraisal or anything like that? Or is it always a physical appraisal? Someone's going out to the property?
It's always a physical appraisal. It's got to be an as-is appraisal.
Yep.
It's got to be rent ready. So when, in cases where people just finished up rehab, we always ask them like, is it ready for inspection? Because we don't want to waste your money, get someone out there, and then they'll be like, hey, there's no fridge in the property. So
That's one of the,
yeah.
that would be one of the requirements, even if the lease would stipulate that the tenant would be responsible for their own appliances.
So if it is, I'm actually working with that at the moment. So if it is the tenant's responsibility, then it'll be in the appraiser's notes, and
Gotcha.
we would be able to see that, and it should
Cool.
be all okay.
Yeah.
When people bundle properties and do a blanket loan, are all those closing costs like present for each one, or is there some kind of a volume discount on the closing costs because you're doing it into one loan?
It is definitely a volume discount. When you bundle properties, it definitely saves you on cost. Because if you came to me and you said, "Hey, I got 5 properties and I want to get an individual loan for each of them," I'd be like, "Hey, wait a second. The only reason you shouldn't be bundling these is because you got one in California, one in Maryland, one in Ohio, one in like that's the only reason you should be doing an individual loan for each property. It's cost effective.
Mm-hmm.
It'll save you on your interest payments. It'll save you a lot of money if you bundle those loans together.
Gotcha.
That's good.
Okay, we're going to jump into our smaller pocket segment. So, Jacob, go ahead and tell us about one of your worst real estate deals or worst loan deals, whatever you got for us.
Yeah, sure. So, something happened recently, where I've experienced is I had a client that called me, and they were like, "Hey, Jacob, I got this property. I want to, I found another property I want to buy. I need the cash. I need to get in. Help me out. I need to refinance this property with your DSCR model." So I get all the info from them. It looks good, and I asked them, I was like, "All right, what's your payoff? Because, you've had this property for 4 years. How much you owe, the other lender or the bank?" And they were like, "Oh, I owe, let's say 125,000." And I'm like, "Hey, wait a second. You owe 125,000 and your property is only worth 165,000. This is not a good time. Your property is, it's not at the value where you need it. And at the same time, their interest rate on the note they had at the moment was 5%. And
Mm.
they told me, they were like, "I don't care. I need the money. I need to get out." I'm like, "You can't get out of this because you're going to lose that 5%, and the loan you're about to get, the only thing it's going to do for you is pay off that debt. And you'll probably walk out with not even, 10 grand,
Mm-hmm.
for this next
Mm-hmm.
property." And it really saved them because they had the opportunity to stay in at 5%, and they realized that they can get a better leverage with me for their property they wanted to buy. And they didn't need the 50, 60 grand that they thought they were going to get from this property. And they
Mm.
only were able to put down a down payment of, let's say, 15%. And I cover, their rehab and their purchase price. So it actually benefited them. And then, obviously DSCR this next property because they're going to hold
Yeah.
it.
So, I mean,
Right.
the lesson here is essentially like using a lender that's going to help you think through some of these problems and not just push paper because they said they wanted to refinance.
Exactly.
Because I mean,
Exactly.
had you could have refinanced, you would have made money if you refinanced, but you were like, hey, this kind of doesn't make sense, even though
Yeah.
the numbers
I'm
could
not,
work, but you're not going to
yeah,
it's not going to have the result you want it to have.
exactly. I'm not here to walk you into a trap or to put you into a bad deal or into a loan you don't need. Um, so it's definitely call your lender.
Mm-hmm.
Call your lender. We'll help you out. I'm not here to get you. We're going to be your partner in this. Another thing which, just came to mind, that happened recently as well. Something very popular, where I live in Baltimore City. There's something called ground rent, which it plays a big part. So ground rent basically means there's an owner of the land, and they charge rent to the property owner on top of that land. And what's happened over the years, going back 100 years now, let's say, nobody knows who that owner of the ground rent is, and it's still active. So there's a lot of struggle that you have to get by to refinance the property because you either have to figure out who owns it and you can pay them off, or you have to redeem it, and it takes a while. So it causes a lot of harm in getting the DSCR loan, especially with your timeline. If you want to close in 30 days and we find out there's ground rent, we gotta hustle and make the ground rent what we call fee simple. You probably see it on an appraisal a lot. So that's what that means, where there's no other, rent or something that needs to be paid down. And then in similarity, like Ohio, there's a lot of issues that come around where a lot of title companies require surveys. And in that surveys, there's something called an encroachment, which you guys are probably familiar with.
Mm-hmm.
Um, and it could really affect the eligibility of getting a DSCR loan because a lot of lenders don't want an encroachment or a survey on their note. It's going to be in the docs and it's going to affect it a lot. So you either got to take care of it or it's just not something you can do. Something I recommend, I'm here to advise my clients. I'm here to help them in any way I can. Best way forward with ground rent is you call a local lender in, Baltimore City or wherever you're dealing with. And in Ohio, you call a local lender because they've definitely dealt with it so many times and they know how to get around it.
Man, having somebody that's knowledgeable is a big deal, and you don't know it's a big deal until you've been burnt a couple times.
Yeah.
Some people pick the right relationships from the beginning, and they don't realize how their success is leaned upon the experience of the people that they're working with.
Yeah.
And we call it dumb tax. You really want to try to avoid dumb tax if you can. And it's just called working with the right people. So I think that's awesome. Hey, all right, we're going to go into our next show segment called our Lil Nugget. Jacob, this is the part of our show where you give our listeners a practical takeaway, a piece of advice, something fundamental to the way you operate your business, or something very pragmatic that they can apply to their investing business.
Okay, amazing. So definitely one idea that I would give, I give it to all my clients and I give it to all the listeners, is BRRRR.
Yeah.
Whatever you can, BRRRR. It is simple, it is easy, and when you find the right lender and the right, I like to say the right partner to help you with BRRRRing, you're off. You're going so high.
And for anybody that doesn't know what he means by BRRRR, it's an acronym, so it stands for buy, rehab, rent, refinance, repeat. So that's kind of the strat. That's the steps that you would take to purchase a property, and then at the end of that cycle, hopefully refinance and retain almost all your initial capital, and then you repeat it and go do it all over again.
Exactly. It's definitely super beneficial, especially when working with a lender that you have a close relationship with, because they know the property from the very beginning, when you first bought it to when you rehabbed it, and then you come back and they know exactly what you're asking for, and it happens over and over again.
Jacob, what's been one of the best resources for you in your business development?
I'd have to say networking. Building those relationships, helping those people that want to be helped and know that they have someone that's by their side and wants the best for them. Because I'm not successful without, my clients and my, the investors being successful. So that's my number one goal. And also referrals. If you help one person out or someone's helping you, don't be afraid to ask for a referral, knowing that when you work with good people, you know that they know other good people to work with. So it's definitely a huge benefit, especially in the real estate industry.
That's good. How can people find out more about you or follow your success?
Yeah, sure. So I'm on most platforms. I'm on LinkedIn. I'm on Facebook. My name's Jacob Singer. So you can look me up anytime. I got my phone number, my email right here. For the listeners, you can call me anytime. My number is 443-393-9580. I'll pick up basically anytime. I'm here for my clients. I'm here for those investors.
One last question that just popped in my head that I meant to ask earlier. A lot of times when I've talked to lenders about this kind of product, the stipulation is you have to buy it in your personal name and it cannot be bought in an entity. I just wanted to make sure, is that the case for you guys?
It is not.
Really?
We can do it either way. We can refinance or purchase a property in your personal name. We can do it in an LLC.
Really?
Between you and I recommend it being in an LLC just because, having it not in your personal name will save you, if anything, God forbid, ever happens.
Right, some liability.
Exactly. No one's going to come after your LLC. So I recommend it, to definitely invest in an LLC, but we can do it both ways. No problem.
Well, that's awesome. Well, thank you, man. This was very informative. And actually, I think you guys, honestly, from what you've said about your guys' DSCR loan products, you're probably one of the best companies I've heard of that offers this product so far. just even some of the flexibility that you guys have.
Thank you so much. Yeah.
That is good. I mean, I truly mean that. So appreciate you. Thank you so much for coming on and sharing with our listeners and us.
Of course. Thanks for having me.
As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.